Good evening, everyone. Bonsoir. Welcome to another edition of Fintech Drinks. We're happy to have you here with us this evening. As people are coming in from the networking sessions, we're welcoming you into the live stage area where it's going to be the main event and where we'll be spending the next hour together. So get comfortable, get your drink if you haven't already. Last time I started I only did it once, but I guess a tradition, so to speak, where I show you what the beverage of choice of the evening is. So another microbrewery today, this one from Quebec. It's called the Saison de la Chasse. It's from the Brasserie Naufrageur, Carleton-sur-Mer. So I'll just go ahead and open that up. As you might have seen, if you got here as of 5 p.m. when the networking opened, you could interact on the right side of your screen. There's an event chat where I invite you all, to take a little moment to just introduce yourselves. Let us know who you are and what brought you here this evening. You'll see that people have already been chatting away. Tariq, I guess, having Jaeger bombs this evening, from what I see. And there's also a poll section. You'll see chat and then poll. In the poll, we'd love to know where are you located. So if you're listening in from Quebec, Ontario, BC, Alberta, another Canadian province, or outside of Canada. So if you could go on there and hit poll, we'd love to see where you all are tuning in from this evening. But we're in for a great event, so cheers, everyone. We'll kick it off right away. Thank you to our sponsors who make this event possible every time, who've been supporting us since the beginning of these online series, so EY and Expertis, for your continual support. For those who it's their first time here and have never had the pleasure of meeting, my name's Nick Belliveau, the head of marketing at Fintech Cadence. I have the pleasure of being your MC this evening, as well as the moderator of tonight's panel, which, by the way, should be fantastic. So if it is also your first time here, how to use Hopin, it's not necessarily obvious. The hardest part is actually getting on the platform. So if you're here and you're watching, congrats, you've made it. You'll see on this side is the chat functionality I was mentioning. So you have event and stage. Everybody's chatting in the event section. So I'll propose that everybody continues writing their questions and introducing themselves in the event section. And you'll see on this side, there's stage and networking. So the networking is now closed. It'll open up in about an hour where you get to meet the other participants here in a randomized fashion, and we'll get to that a bit later. And you'll also see on this side, you have also the polls that I was mentioning, so you can let us know where you're tuning in from. Cool. So I'll kick it off by just introducing very quickly what we do at Fintech Cadence. It'll be followed by an introduction of EY about tonight's topic. We'll then dive into the panel for 30 minutes, followed by a 15-minute Q&A. So that's all going to be happening tonight on the main stage versus last time where we moved into sessions. Tonight, you don't need to go anywhere. You just stay on this main screen, and then we'll kick it off or end the evening with the networking at 6:30. Go and take a sip because I've been speaking a lot. Cheers again. All right, Fintech Cadence. So at Fintech Cadence, we're a nonprofit organization that acts as Canada's FinTech hub. We're on a mission to really develop future FinTech leaders. So we're the starting point for anybody interested in FinTech across Canada. And we're based on 3 pillars, one of which is education, the second, supporting FinTech entrepreneurs, and lastly, collaboration. So collaborating with financial institutions in open innovation competitions to really be able to create together and innovate in FinTech and the financial industry in general. We have 3 programs that run throughout the year, one of which is the certificate. It's a 12-week program to learn the ABCs of FinTech. That happens every winter, so the next cohort starts this coming January. We have Ascension, which is an incubation program for early stage FinTech startups. That as well kicks off this winter in February 2021, and applications already open. So if you do have a FinTech startup, invite you to apply. And also the Formathon, which is Canada's biggest FinTech competition, a 3-week competition where our partners bring challenges and teams form to be able to find solutions and potentially either build a startup or work on a research project to solve those challenges. We also host a number of events. So Fintech Drinks, what brings you all here this evening, our monthly meetup to meet and chat with the fintech community. We have the career fair event for anybody looking for a job in fintech, and the university series, where we go around different universities in Canada to educate students about what financial technology is all about. We have another program that we're partnering with Desjardins on, which is really exciting. Startups have the chance to win a $25,000 cash prize and also get admitted into the Startup in Residence program at Desjardins. It's for startups who can address the challenge that you see on screen. How can we help Canadians reach financial empowerment? So if you have a startup that you think you could address this challenge, we invite you to apply. Application deadline is October 7th. And the criteria are you have to be at least a team of two people in the team, one with a technical background. You have to be incorporated and have an MVP. And you could find all the details. If we could share the link in the chat, you'll be able to check it out. So just look in the chat section, and we'll share the link very shortly. Perfect. All right, now on to the next portion of the evening. I've chatted a bit. Now to pass the ball to Ron Stokes. He's going to give us an introduction to transaction life cycles. So if Ron, you could join me on stage, please.
Hey, Ron. Hey, Nick. Sorry about that. A little bit of technical difficulties here. I'm better at the transaction life cycle than I am at working in technology.
Honestly, it's not an easy platform, so I'm glad you could join me. So we'll be chatting about transaction life cycles, but maybe first and foremost, could you tell us what transaction life cycles are?
Yeah, Nick. So, I think the topic that you're going to delve into with the panelists is going to be very exciting. And what we'd like to do to kick it off is to talk through a transaction lifestyle. So how do you go from the beginning point, which is you've decided you want to embark on an M&A, non-organic growth strategy, all the way to the point where you integrate this new organization into your in a traditional way into your existing operations. And so as we move through each of the phases, we'll have a good discussion around what typically happens in these phases of the life cycle, and then I think it puts into much better contents for all of your participants, how to think about the speakers and how they're responding to it and where it fits in the transaction life cycle.
Perfect. So maybe we could take like an example of a fictitious company, and you run us through what it's like to run through this life cycle.
So we're going to take fictitious company A. And the exciting part about M&A is there will always be company A will be acquiring company B, but instead of referring it to as company A acquiring company B, it'll always have an interesting project name. So we could call this Project Fintech. They
fitting. It sounds very fitting that way.
So company A will go out, and what do they? What's the typical process around it? In the first stage is M&A strategy, and what M&A strategy will be is company A will have looked at its business operations, look at its organic and inorganic growth opportunities, and would have said, look, if we can find something inorganically that'll accelerate our development, whether that be anything on B2B or B2C side, or acquisition of another company, we will take a strategic look at it and recommend moving forward from that stage. So, the first stage is really company A making the decision that they're going to look through it. And typically at this stage, there might be 100 potential targets that fit their particular criteria. Could it be, might be an example, could be acquiring a fintech company that's going to help better digitally enable sales to their customers. And so a strategic list will be pulled together. There'll be 100 or so items on it, and it'll be whittled down to a potential 3 that have the right fit to it. we call that phase 2, which is the target screening process. So, does it meet my strategic objectives? Is the company aligned in terms of values? And, what is their value proposition when we bring them on board? And at this stage, there's probably some preliminary due diligence. And what is preliminary due diligence? For all your listeners on the on this webcast, if you went out and bought a new home, or you were looking to buy a condo, you would typically put in what they call a home inspector, and the home inspector comes to look to make sure that the home is really what it's rep to be. So the diligence stage is really going through looking at the customers, so looking at the IT operations, looking at the technology, the ownership of the IP, in this case, to enable a better digital experience. And that's preliminary due diligence. This is then followed by a transaction strategy and due diligence execution phase, right? So at this point, company A is now working with companies B's sell-side advisors, companies A professional advisors, and what they're doing is really trying to assess what's the value of company B. Because company A wants to make sure that they're appropriately rewarding and paying for the company, and company B wants to maximize the value of the sale to the participants, right? So things they look at is, what is recurring cash flow? What's the balance sheet like? Is the IP address actually owned, not owned? And so this is very helpful diligence phase, and really it's just making what I would say is it's a lot of making sure that company B is what company B says. Then you get into, the real nuts and bolts, which is post-merger optimization, synergy analysis, and integration. And this is where company A starts looking through company B and says, company B had a certain target operating model. Now it's going to have a slightly different target operating model as it's merged in with my particular entities. And so, what does that look like? And what that typically would be is, where will the developers sit in the new organization in company A? How many people are actually needed to continue that business? In the IT side, it'll be, there's a system that's been developed. Now it's being plugged into, let's say company A is much larger, a credit union, a bank. How do we take that initial pipeline concept and really now have it work for the volumes that will be coming through this customer experience digital portfolio? And during that stage, as you're thinking about the target operating model, there's also negotiations on finalizing the purchase and sale agreement, negotiating any of what they call TSAs if company B is a carve-out. But really, I think that's what we would consider the transaction lifecycle. How do you go from initial concept of inorganic growth all the way through to an acquired company? And that's on an acquisition side. I'd say lastly, in my last few seconds that I have here, is this also leads down the same route as if you're moving on to a partnership, a joint venture, a strategic alliance. Maybe not all of them will be there, but the same cycle follows for a transaction life cycle. So thank you, Nick. Happy if you have any other questions.
I do have other questions for you, Ron, and maybe we could get to them in the Q&A, because I want to know like the duration of all this, and maybe some more details on some of the steps, but we are out of time, like you pointed out. So I hope you could stick around, but thank you, Ron, for that presentation, and we'll move on with the main event.
Thank you.
Thanks for joining us. All right, so I'll just go ahead and share my screen again. So like I mentioned, now we're on to the main part of tonight's event, our panel discussion, which brought you all here this evening. So I'd like to introduce our speakers tonight, our panelists. So first up, we have the pleasure to have Robert Paterson. Mr. Paterson is President and Chief Executive Officer of Alterna Savings and Alterna Bank. a position he has held since April 2013. He has worked in financial services for over 30 years prior to joining Alterna, and Mr. Paterson has held executive positions within companies such as CIBC, JP Morgan Chase, Aon Corp, and McKinsey Company. Mr. Paterson is a director of the Cooperators Group, Payments Canada, Central One, Alterna Bank, and Enactus Canada. He also sits on the advisory board of the Deans of the Arts and Humanities at the University of Western Ontario, as well as the Dean Advisory Board of the Sprott School of Business at the University of Carleton. Mr. Paterson's employment experience includes all aspects of retail, small business, and commercial banking. He is a pioneer of emerging payments and digital technology, and has also championed innovative lending solutions. In addition, he has positioned himself as a leader and a mentor in the fintech space. He is an active educator on social media and is a regular speaker at industry events like the one we have this evening. Mr. Paterson is a graduate of University of Western Ontario. Thank you, Rob, for being here with us this evening. Next up, we have Ranjit Sarai. Ranjit is the VP of Digital Banking at Credit Sesame, responsible for developing the product strategy and roadmap of Sesame Cash, one of the fastest growing challenger banks in the US. Prior to Credit Sesame, Ranjit was co-founder and head of product at Stack, a Canadian challenger bank and banking as a service platform. Stack was acquired in 2020 by Silicon Valley-based Credit Sesame. Prior to his role at Stack, Ranjit was the head of digital strategy and innovation at President's Choice Financial, where he led enterprise-wide digital transformation and launched PC Labs. Ranjit was also director of mobile banking at CIBC, responsible for launching several innovative mobile banking products. Ranjit holds a software engineering degree from Concordia University in Montreal, as well as an MBA from the Ivey School of Business in London, Ontario. Ranjit, likewise, thank you for joining us this evening. And last, but certainly not least, we have Corey Gross. Corey is the co-founder and CEO of Sensibill, a leading provider of everyday financial tools and SKU-level data that helps institutions better know and serve their customers. He is an award-winning repeat entrepreneur and thought leader in the world of payments, digital banking, and receipts. In just 7 years, Gross has grown Sensibill into a thriving fintech with a team of more than 70 strong. Gross has led Sensibill through 3 funding rounds, including its most recent Series B round, which raised $41 million Canadian. And to date, Sensibill has partnered with nearly 80 financial institutions across the US, Canada, and the UK. Corey, thank you for joining us as well. So your moderator for the evening, well, like I mentioned earlier, it's me. So I do not have the credentials like the panelists I just mentioned, but I'm a curious one, so I'm excited to have on these 3 gentlemen. And on that note, if you could please join me on stage, I'd love to get this panel started. So Rob, Ranjit, Corey, good evening. Hello. Hey, Ranjit. All right, well, first off, thank you to the 3 of you for joining Fintech Drinks for the first time. We're super happy to have you on board. Ranjit, I'd like to kick it off with yourself. So you've gone through an acquisition, and could you just start with the story of what it was like to live an acquisition as a startup?
Yeah, sure. And a lot of the stuff that Ron talked about in terms of the transaction, we lived through that and more because it was a cross-border transaction, so it's some additional complexities there. But yeah, we were fortunate that we actually started our relationship with Credit Sesame as partners. So we were, at I would say late last year, began our discussions with Credit Sesame in terms of a partnership to launch what now is Sesame Cash. And through that, we really got a feel for how that company operates, the leadership, at every level, right? And in terms of the working teams working together, the developers, engineers, all the way to the top of the house, and really working together as partners. And that, naturally progressed to discussions around acquisition and, everything Ron mentioned, that and then some, everything from tax implications to legal implications and agreements. These things are not simple, but they're doable. And then in the end, it worked out great. I mean, the entire me and the other co-founders are now all part of Credit Sesame. The entire employee base, we're about 50 people in Toronto, are all part of Credit Sesame Canada, and we're all working towards the same goal. So yeah, fortunate in that respect. It went relatively well.
So end to end, what did that process, how much time did that process take? Because you've co-founded it not too long ago, and then very quickly moved into an acquisition play. So how did that play out, and when did you start considering an acquisition?
Yeah, we started the journey around 3 years ago. We were all working, and me and my co-founders were working either in banking or MasterCard, and within payment networks, and we saw a gap in the market to have a product such as Stack, and we launched that. We started the company around 3 years ago, and we've been working on building Stack. And I would say about a year and a half ago, we started working with partners on our B2B payments platform, and we actually started with credit unions. We worked with Solero to launch an amazing program in Central and Western Canada. We spoke with Alterna as well. Rob might be aware, not with Rob directly, but with his team. And so credit unions are an amazing platform for innovation. I mean, they're the original disruptors of financial institutions and banking, right? With the no fee and equity structure of their members. And so they're very welcoming, and we worked hand in hand to launch this B2B platform, this white label platform. And that also led to our discussions with Credit Sesame, because now we were in the market with a payments card and platform. And again, that started, with Credit Sesame late last year. Acquisition talks really kind of came into fruition this year. Before COVID had started, COVID slowed everything down. I went, I did a mortgage refinance, took forever because of COVID. So you could imagine a cross-border acquisition taking a bit longer. So it takes a few months. It always takes longer than you expect. There's always more details than you think. These are not simple transactions. They're quite complex. And so it takes a few months for an actual transaction to go through. So that's kind of how we landed to today, right?
So maybe on the other side of the table, so for somebody who's acquiring, Rob, yourself, who've lived, as an acquirer, how does that process generally go for you? And do you have any stories you could share about acquiring fintechs?
Yeah, look, I'll talk from an industry perspective, because it's really interesting to see how the differences in the different sectors and the different sizes play in. If you look in the large banks, they really have a history of devastatingly bad, acquisitions, right? And, I talk to a lot of fintechs about being careful, about those acquisitions, right? It's good sometimes for the cash buyout, but it often means the IP that's been created can be shelved, can be destroyed. The value creation, the problem we're trying to solve, can be absolutely ruined. With us, we've been very careful that when we are going into the fintechs to, since we call it more partnering up, that we try and take initially smaller investments in it. So we start with a relationship component to make sure we still keep the fintech at arm's length. I know it sounds kind of strange, but we want to be very careful of keeping the DNA intact, of the organizations. We've looked to one of our biggest opportunities was really partnering with Paul Desmarais. And I know if Paul and the Portage Group, and we made the decision to put, quite a few million into Portage so that we could then have ownership stakes in a variety of fintechs. And then through that ownership structure, we're able to get our team in around the table to help not only just assimilate their technology in, but also start to get some of the DNA to be transitioned from, an organization that's been around for 18 months to 24 months into what we are, which is a 112-year-old organization. Corey always says, I don't look a day over 100, right? But it's we're an old institution. Yeah. And we want to keep that nimbleness. So we really try and find those pooled partnerships to jointly buy in with other individuals so that we can, get the benefits out of ownership, being able to be under the hood, being able to see the P&L, understand the research, the IP, but at the same time, not tarnishing, the creative value of the management team, leaving them intact, and allowing them to make us better and accelerate our thought process. I'll use Corey as a classic example. We didn't buy a part of Corey's, organization, but we've worked very closely with him. He's a key partner of ours, on our mobile platform. And, Corey has put a key person into our business at different times to help do some knowledge transfer and build some capability. And we found that that's worked out a lot better than just trying to go and acquire the entity and bring it in. When you look at the Tangerines of the world, they went from being these great attacker plays, really doing meaningful change, getting rid of friction in the client experience, to being owned by a large bank and then, being absorbed, destroyed, and compressed. When you look at President's Choice, I'll go to Ranjit on that. I mean, I was one of the people at the beginning around the creation of PCF. It was a great offer, great value. It got compressed, right, as it came into more of the core of CIBC, over the decades. Now, Laws is going out and doing it again on their own. I think they're going to be very successful. So, big thing for us is we try and make sure we keep the entities intact. We keep the DNA intact, the operating model they have, keep it off to the side, don't bring it into the mothership, and try and ensure that creative talent changes us and we don't in fact change them. Just very different.
I think that makes a lot of sense, and it's a good philosophy to have. But do you see that actually happening throughout the industry, or would it be on the more of the counter side where people try to really integrate it, bring in the team, but then it doesn't end up working out as well?
It's starting to change now in the credit union space. And, as Ranjit was talking about, we're a little bit more entrepreneurial in that space. We're smaller, so we don't have this belief we know it all and that, we know better. We also don't have the internal politics and layers that the large institutions have. So, I think, fintechs will find the credit unions are more partnering in their approach. They're more willing to buy in that the other party knows this better than we do. And so if we're going to pay and we don't have the same money that the big five do, if we pay up to buy, we really want that value to grow. So we're happy to stand back and let that business grow. So I think if you take a look at the largest 10, 15 credit unions out there from the West Coast to the East Coast, I think they're great targets for fintechs, especially that are looking for capital investment, right? To do a raise, to get in some, what's the right way to say it? Capital that's not fully constrained, that's still going to help them to be able to grow and to develop. Versus the big five, I think, are going to put such constraints on. They're going to want non-competes. They're going to want, all the things that would actually kill the end. Maybe I'll throw it over to Ranjit and Corey. I mean, has that been your experience, in looking at the credit union space as a partnering tool versus the big five? I mean, I know Corey's got a lot of examples around there, but Ranjit, you do too. I mean, how does that resonate with the two of you?
Go for it, Corey.
I mean, I think our experience, I would say, with credit unions is, to your point, Rob, you made a lot of very, very kind introductions to credit unions across North America that we've been fortunate enough to be able to partner with. And we have through digital banking partnerships we have in the States as well. And there's just like Rob said, a mindset of entrepreneurship, hustle, and wanting to focus on the customer that isn't necessarily the thing that can be as top of mind for larger institutions, state super regionals and up. And here, obviously, with the big five, it's very hard because there are so many interests at stake to have to focus on, the issues that those who are financially vulnerable face, right? But when you're a small credit union, you're building relationships with these people constantly, so that when a fintech or a software company comes to you with a solution for those particular personas' problems, you're going to listen because they're very meaningful members for you. So I think it's just part of the culture of credit unions to have a partnership mindset. Whereas, I mean, what is absolutely true is, I mean, we're a partner of JP Morgan Chase, and they have thousands of vendors, thousands of pieces of software that they procure. It's really hard to partner truly with a fintech in that type of way. They certainly make acquisitions for those fintechs that they find are strategically valuable for them, and they'll certainly promote and invest in partnerships that they think where the stars are properly aligned. But when you have that many types of partners, you're not being selective so much as you're kind of spreading, you're spraying and praying, right? So I think our experience with the credit unions and Alterna is absolutely being the case as well. Very selective about the value proposition and the partnerships that they choose to deploy, because they have a brand and members and an entire culture to protect. It's very important for them to make the right investments. So this is, to Rob's point, aligning Alterna with the likes of a Portage. That's a very strategic, very personal process to create that type of relationship. It isn't just a spray and pray mentality, because it's not the same. There's not the same resources available. It's not the same scale available that a JP Morgan Chase or an RBC has. So I'm certainly aligned to that.
I would agree. And I think, the other angle is like, some of these large banks have such massive tech debt and such massive platforms that their first intention is when they see a startup, it's like, that's great, we'll just build it ourselves, right? Because why are we spending $300 million a year on IT if we can't do it ourselves? Whereas, credit unions are lean by nature, right? All the money they get, they push back out to the members, and they're flat organizations, right? And so when you're dealing with a flat organization, the sales cycle, and Corey could probably talk about that, having to deal with banks, is a multi-year sales cycle. With a credit union, you could get something signed and done in months or weeks, right? Depending on the organization. That as a startup is huge, because you're in the market, you're live, your proof of concept it's beyond pilot, you're actually live in production. And then you could parlay that to other deals and other stuff. And again, it's not like you shouldn't talk to the big banks, you should. Just know that it's going to take years, if anything. Whereas a credit union, it's much quicker. So I recommend to any startup, talk to credit unions first, because you're dealing with a flat organization. And yeah, I was at PCF, and we could probably share stories. I was with PCF through the breakup, and a big part of it was, PCF is very nimble. It's 200 people, right? The CIBC business to support it was like 600 people. I remember going there. I was like being in Bizarro World. I was like, there's 4 people for everybody we have at PCF. What are they working on? It's just the nature of CIBC, such a large organization, needs that kind of infrastructure. And so that deals with things like culture, getting things done, IT, tech investment. And so again, dealing with a more nimble organization that's physically smaller in terms of people and flatter means you'll get easier access to decision makers quicker. And the fact that they are looking to leapfrog technologies versus trying to re-engineer what they have, credit unions are much more open to partnering in that aspect. So it's a good avenue to go to if you're a startup, for sure.
See, I wish I hung around these guys and they were my friends earlier when we started the company, because I would have listened more, because we started top down. And to Ranjit's point, it's a hard slog when you're working with big banks. And a lot of people said to me when we were building Sensibill, this is a fool's errand. Like, I don't even, like, this is before fintech was popularized as a space. The idea of fintech was simply to disrupt, because banks were so slow. So by all means, bite off traditional profit centers, follow the lending club model and so forth. And here we were trying to actually work with big banks. But I'll tell you, might we have been further ahead if we started with credit unions and cut our cloth with them as we moved upstream? Sure. But yeah, it is definitely a different world.
And maybe it's a Canadian thing, but you'll see this a lot of banks. No one's going to say no to you, right? They'll take a meeting. Like, they'll meet the startup. They'll meet the hot startup. You'll have 10 meetings, but you won't get anywhere. And it's kind of similar with investors too. Like, no one's going to say no to you. You almost rather hear no on the first meeting and be like, guys, this is great. But the reality is a lot of big banks, their 2-year roadmaps already in place. Like, the annual planning process is a 2-year, especially on the IT side, like the next 2 years have already been baked. Maybe there's 10% leeway to do something new. But to bring in a new vendor and change a business model at that level is not going to happen for years. And it's better to hear that up front than later. The thing is, people are too nice to say no sometimes, and you kind of get dragged down, which I'm sure.
The passive aggressive Canadian way.
Yeah, 100%.
I think you're all sharing some very valuable advice. A lot of the time, startups really focus on the banks because it's just what's known, and it's what has that clout when they do the presentations. And you bring up a very valuable point, because Corey, to your point, approaching the credit unions are much more open to partnerships and can become the first clients. But then that leads to my next question. Then are merger and acquisitions like a viable strategy from the get-go, or you should just really focus on partnerships, and then if an acquisition proposition pops up, potentially consider it?
Yeah, I don't think acquisition is not a strategy, right? So you should focus on building the business, right? Focus on scaling it, building it, getting right product market fit. Partnership is a strategy. I think, it becomes a way you could get to market by partnering. And I think, not to knock big banks. I mean, I work there. Like, there are banks that are doing things a bit more interesting as well, right? You have RBC Venture and all these different exciting things popping up. So it is evolving. By no means don't go to them, but I think a lot of people kind of don't think about the credit. So that was my point there. But at the end of the day, starting a company to get acquired is not a strategy. It's not a good plan. It's actually you'll probably be disappointed if that's your plan. I think you have to focus on your product, building it, getting customers, working with partners, and that's kind of the acquisition will come, and if it's the right time, it's up to you. But you could build a really strong, sustainable business through partnerships. I mean, look at Corey, right? Raised a ton of money, thriving business, massive partners. Like that's a really good path. And I'm sure, if acquisition came down, he'd look at it. But it's not. Correct me if I'm wrong, Corey. It's not your go-to.
I'm not smart enough to engineer.
Yeah,
There are some entrepreneurs who are really good at these 3 to 5 year plans. They try to maximize their equity holdings, almost raise no money. They get to 3 to 5 million of revenue run rate, and then they look to get acquired for $40-50 million. And believe me, that's a way to build wealth if you can do it. I'm not that smart. I'm not one of these guys who can be able to perfectly scientifically engineer corporate behavior and manipulate those dynamics to put myself in that kind of situation. The only thing I know how to do is focus on problems that I think that if you solve, make the world a better place, build relationships with people to help you learn what you ought to do to be better as a company and build towards a stable business with product market fit, as Ranjit said, and profitability, because then I think you have the optionality to either keep building your business or if the right opportunity comes along for all the stakeholders, well, then you have actually something to discuss. But until then, to me, it's nothing.
But Corey, you're selling yourself short. I mean, you're very good at how you've managed the relationship side. And, this is where I'll make the plug for, credit unions or small banks, to help fintechs really grow. Getting additional capital and from a series of small FIs, the beauty is you don't have the same egos, right? So we're happy to be the calling cards to help you get the next credit union or the other bank and make introductions into the ecosystem to help you build up. And Corey's great at that. The last time we got together in person, we had our meeting in Vegas at a blackjack table, right? To be fair, they weren't dealing. We just used the blackjack table. But that's being very entrepreneurial. People are seeing you having a talk. They're saying, hey, who are you talking to? They're engaging. It's, the ability to get smaller institutions and help build a base of proven value is immense, right? And, I recommend each fintech to go out, get in a number of small FIs to prove up your hypothesis, get real data. And then when you go to the larger FIs, it's a couple of things. One, they're more interested in you because they've probably seen or heard, or, you have real quant to go forward. The other part is in your negotiations, if they're going to buy in, buy out, or what have you, you have a greater positioning power when you have a track record of success in, they see the credit unions or the small banks. They know that you're going to be able to sign more up. They know that you're going to be able to penetrate. So they realize that they're going to have to come a little bit more in the approach of how they're going to allow you to continue to survive, right? The ability to really diversify structure in the early stages, your capital raising in the early stages with more small FIs, I think is going to help you. And I think you're going to find that those FIs are going to help share their insights to, give you a little bit more of the older banker, structure, in it, so that you are a little bit more informed. Like Corey and I, constantly have those touch bases just to give the perspective of the other side. And, I look at Corey, he's built a successful base now, right? He's global, right? He's in multiple countries. He's got large brands, small brands, medium brands. And so if someone comes to buy him out now, I think he's going to be in a much stronger position to monetize that than he's saying. Corey's going to, be, in that palatial condo in Miami having a really good party when COVID's over, right? And I'm only hoping that we all, Ranjit and myself and Nicholas get invited to the closing party.
Around a blackjack table.
We can pass my daughter around to play, babysitter. It'd be great.
Yeah. But Rob, a good point. I think it's again, and Corey said that, like, if we knew this before we started, it took us about 1.5 years on the stack side. I know it took Corey maybe a couple of years to crack into that credit union market, but knowing that ahead of time, I mean, like, we work with Solero, and they've been amazing partners to this day. We work with them weekly. They introduced us to Rob's business and his colleagues there. And credit unions also work well together, which is interesting because their business initially used to be regionalized. Now they're national, or they're multi-province, but they still have that kind of ability to work together, and they're more cooperative than they are competing against each other for the most part, is what I've noticed.
So we spoke a lot about, how well, from the get-go, an acquisition is not the roadmap you necessarily plan for, but it can happen. And when you do, so even though it's, not part of the, from the get-go, if a later stage startup is getting, considered for an acquisition from an FI, how do startups generally prepare for that? What are the first couple of steps? I know Ron in his presentation got to it, but from your experience, maybe Ranjit, what did you guys have to do on your end to set it up such that it was able to go through?
I mean, I would say it's not too different than raising money, right? So when you raise money for a serious round, you're going to get the due diligence request, which means you're going to build all the documentation that everyone's going to need in terms of putting together your metrics and your KPIs of how the business has been operating and kind of the growth. And so you set up these data rooms. And so I think, we're pretty down the path of doing our next funding round. And so we'd had prepared a bunch of these documentations. And so that's the initial kind of stuff that after the kind of initial, business kind of product fit is there and the due diligence starts when the acquisition, make sure you have your data room ready and all the paperwork and stuff that you need. And then I think it's really like, I mean, I'm not an expert by any means. I went through it once, so hard to know what's unique to us and what is kind of common. But I think there's, common steps around that diligence process that obviously takes longer, right? I think you have to figure out, just like when you do with an investment round, obviously, what is the valuation, right? And in terms of what is the amount and how much of that is equity, how much is cash, and all those details. And then, making sure your board and everyone is kind of aligned and on board, obviously. And so, I don't think there's a set playbook, but at a high level, you kind of go through these actions. And again, getting good advice and counsel, like, I can't stress that. You can't do this on your own, like in terms of, if the startup was designed to launch a product and launch a business, it's not really the same people that will help you get, through the acquisition process. You need kind of professional help in terms of that perspective. So definitely make sure you get good legal advice and kind of go through the details of that share purchase agreement when it comes to it, right?
Perfect. And Corey, for yourself, at Sensibill, you guys did. Could you run us through that and explain how that went and what that's all about?
Yeah, I mean, we knew that a big part of our roadmap and our solution was going to be based around AI and machine learning, and that was going to require that we have very specific expertise, right? And just to give folks a bit of background, what Sensibill does is it helps customers manage expenses at a very granular level by ingesting receipt data from you taking pictures and using OCR, all the way through to ingesting purchases you make online at e-commerce stores and also at brick and mortar stores that you buy stuff at and get an electronic receipt. And a big problem that we solve for technically is and normalizing all of this data so that it becomes searchable and it can actually start delivering insights back to you in aggregate about your spend. And that's a very difficult problem because receipt data is very unstructured. It's not like a check where everything is kind of the same size and information is usually put in the same places. receipt data can come in various shapes and sizes and formats and so forth. And so what we did was, first of all, we had some really strong engineers inside the company, including my co-founder in the early days, who was very good at identifying talent and very good at identifying, I would say, in particular, the types of innovative souls who don't feel bound by limitations, right? That really push the envelope. So what we did was we scoured for talent, and what we did was we found a company that was actually building something akin to a receipt data extraction tool leveraging machine learning. And we tried the stuff that they were building, and it was impressive. And this was an early stage company, only a couple of employees. And so what we did was we just figured we would help. We would add them to our team, so bolstering our machine learning and AI capabilities internally, and that was a win for them as an early exit. And now they'd be able to live out their dream because obviously our goals and objectives and passions were very well aligned in terms of the problems that we wanted to solve, and we provided them more opportunity to be able to do that. And so I think that's where acqui-hires become very opportunistic on both sides, as the individuals being acqui-hired. Good example, this was Jet Cooper into Shopify very early on. I don't know if folks might recall, Jet Cooper was a product design shop in Toronto, certainly a notable and popular one. And now Satish Kanwar, years later, is like the SVP of product at Shopify, right? Because they needed to bolster their product talent because it was harder to come by in this ecosystem in the earlier days of the tech bubble building here in Canada. And so those are good reasons to acquire upstart companies, and it's to bring in talent that you otherwise might have had to labor in terms of finding and testing against whether their values or their fits as far as you wanting to accomplish common goals. So we did that, and the process was really, hey, we like what you're doing. We'd love to be able to put an offer out that made sense for both sides, and very quickly that was able to be pulled together. But I would say it's nothing near as complex as a financing or certainly the type of acquisition that Ranjit had gone through. I'm still early there.
Okay. Gotcha. I have two more questions before we move it on to the Q&A and open it up to everybody. If you already have questions, feel free to use the chat function. I see some people already typing, and Rob, you're already making some connections. But from your perspectives as an industry, do you see differences in M&As in fintech versus other sectors of the industry? Is there any specific things that people should know about, or it's pretty much the same? Rob, maybe for you.
See a huge difference, in it. And look, I'm old enough to remember the .com days, right? And having lived through that, I think it's still, very similar in how it's transacting. I think companies are starting to think a little bit differently about how they leverage the talent, the capability, and the IP when it comes in. Ranjit was talking, earlier about the President's Choice Financial and some of those other scenarios. I mean, I think the blueprints he was mentioning that organizations have, they're starting to realize, the big, large FIs, that they need to be more nimble and be willing to crumple them up. When we at Alterna Bank, or our Attacker Bank that we run digitally nationally, we created the first digital mortgage in the country, end-to-end process. You never have to see anybody. You can fund it out of a kayak up in Algonquin Park. And the TD executive team, when they heard about it, I know there was a big kaboom. I was speaking at Salesforce's conference in San Francisco and walking through, because we use them. And the exec team had a real beat-up session back in Toronto, because they'd been trying to do this for many years and they couldn't understand how we were able to get there. This very, very small institution. And so I think those stories are causing the visions to accelerate. So they're more willing to bring in talent and IP. But the actual papering of the deal, once the lawyers get in and all that, I feel it's just very traditional, right? I see very traditional processes being used and not a lot of creativity in the deal structures. That's been my personal bias, but I'll look to Ranjit, who's just gone through it for his view.
I think I would say they're similar to other regulated industries, right? So if you think of like fintech, probably the same consideration as a health tech company there. So I'm not a health expert, but if you're in the health field, you have that vertical knowledge that someone else doesn't have. And so it's obviously, a bit more attractive. I think, in the fintech space, it's relatively specialized. I think the word is used a lot, but in terms of people that really understand, let's say it's in our situation, it was really around payments, payment networks, interchange, and how that model works, and really extracting value and building some, we built some really unique things really early on around instant cash back, at the point of sale, where people normally wait 3-4 days to get a cash back. And we built the whole CardLinks, program in-house, proprietary. And so I think when companies looked at us, even investors, like you could tell if someone or a team of people understand payments or came from a payments background or understand fintech inside out, because there are specific industry level details that you should know about. And I think, part of it is you could work at a bank and gain that knowledge. It might take a few years because things move slow, or you could start your company and just learn it on your own. And I think that's a part of it. I think that is evolving. Things are getting abstracted through, the Stripes of the world and others. But at the end of the day, like that knowledge is key, and being able to build the product around it. I think, you'd be recognized for it as a fintech, just like you would be in other verticals like a health tech or potentially ed tech or the verticals, right?
Perfect. Yeah, that makes complete sense. And a good example. We'll open the floor up to questions now. I see some people already wrote some, so I'll just scroll up in the chat, and I see Tariq had one. The first one I see: would you tell smaller credit unions and banks who think due to their limited resources, money, tech, or people, they can't innovate like the big guys?
Yeah, I'll tell you, I mean, it's the reality is you can. I mean, this is where the fintechs are the accelerant. We honestly have made a lot of digital firsts in our banking play, our national banking play, through partnering with fintechs. The beauty is it allows us to plug IP in instantly, to accelerate our offering, and to then all of a sudden inherit a whole other development team that's working on extending that part of our offering forward. APIs were the leveler, right? For small banks and credit unions. We always thought of doing something like Corey had done. And the beauty when we partnered with him is now he was plugged into our credit union mobile offering. Done. Corey would be phoning every week. Hey, we've advanced this. We fixed this. We're adding more capability. And it actually allows us to compete at a higher level, head to head with the big five. So the pitch that when Corey comes and says, can you help with an introduction here or there? My comment to them is Corey brings talent, capability, and future IP to your organization. Bolt him in. It's going to be a fair transaction price. It's going to be cheaper than if you tried to hire a team to build it. So it's actually more cost effective, and it's going to extend your value proposition into more areas than you'd be able to afford, execute, or acquire talent on yourself. So I'm a huge believer that the more fintechs we can plug in to solve the real problems we have and the real friction that we have with our consumers. Flinks is, Nicholas, Flinks out of Montreal. They are a great partner for us on all of our account opening capability. And now we're trying to work with them on more data analytics, right? It's huge, makes us so much bigger than we are in partnering. So it's not a question of, can you? You cannot do it without the partnerships is my view.
Perfect. Thanks, Rob. See another question from Abhishek here. So it's for Ranjit, this one. He asks, with the Stack and Credit Sesame combine, is there any updated mission on financial empowerment? Despite of many tools available, when it comes to making financial decisions on a day-to-day basis, Canadians still have a high level of difficulty. How are you looking to change that?
Yeah, that's a good question. I think it's a North American reality, right? Most in the U.S. and I was surprised in the U.S. and the Canadian data was very similar, that more than half of North Americans are paycheck to paycheck, which means like if you miss a paycheck, you're going to be in trouble. If you miss 2 paychecks, you're going to be in severe trouble, which means you're looking for alternate sources of financing to cover, let's say, an unexpected car repair. So you're going to payday loans, and then once you start that cycle, it's very difficult to get out. And so the beauty of the partnership and acquisition, and it's funny we call it merger, but it's really like the acquisition, right, of Stack by Credit Sesame, is Credit Sesame has been around for 10 years. Built an entire business, raised over $100 million based on being experts in the field of credit and how to manage your credit. And not a lot of people are aware, they're becoming more aware now, but your credit score is really a gateway to your financial kind of health, right? And people could get apartments in nicer areas based on their credit score. It actually is a life-changing event to improve your credit score. It's not just a number that sits there. And so they came with expertise on the credit side, how to manage your credit, tips to improve it, machine learning around actions to take to improve your score. And what we brought to the table was seen as, we see it as the other side of the equation. It's the cash side. It's money coming into the system. It's payroll. It's being able to pay your bills, save money for goals, save money for a rainy day. And so, the way we view it is, the actions you take on the cash side lead to better financial habits, which is reflected on your credit and credit score side, which open up new opportunities, new financial products, lower APR loans, lower APR credit cards, and kind of that cycle, kind of think of it as a flywheel, right? And so I think that's what we're bringing back to Stack. So I think, on the Stack side, it was really focused on cash, and now we're opening up to this whole new world of, it's also your credit and your credit growth and score and credit health. And so we're actively looking at bringing some of the functionality that exists in the US with Sesame Cash and Credit Sesame into Stack and saying, how do we help people make better financial decisions, right? And again, understanding your credit score, and how to grow it is a key part of that financial equation that we're looking to bring. And I think, another thing to add on just the previous question as well is, I think as a startup, like, take advantage of the current situation. I mean, COVID's a horrible thing that happened as a pandemic, but if there's a silver lining, it's a lot of businesses had to get online very quickly, including banks. And so I think banks are realizing things like not having digital onboarding doesn't make sense, because you can't actually take your signature card or go to the branch because the branch is closed, right? Everything's shut down. And so there's a window here where, I don't know what the stat was, but 10 years of e-commerce happened in like the first 3 months. Companies that weren't selling online had to figure it out in 2 weeks or they'd be shut down. So it's happening in banking. I think the laggards or the incumbents that haven't yet moved there will move, and they'll look for solutions to leapfrog, which hopefully fintechs that are part of this discussion here can provide that service as well.
Following up, Ranjit, with COVID, I think it's interesting. Do you think it's going to bring more M&As from big banks saying we need to move quick and just integrate solutions from existing fintechs, or we're going to see more partnerships and M&As are going to drop? What do you guys foresee in the next year or two?
I don't know. Yeah, I'd love to get Corey and Ross' perspective too. But I think it will speed things up. I think at the end of the day, whether it's M&A, investment, or partnerships, it could be all of the above. But I think it's going to speed up because you now have execs sitting at the bank saying, "Why are we losing? Why is this a horrible month?" And it's like, well, it's a horrible month for account openings because our branches are shut. And it's like, oh wait, branches are where people have to open accounts. Like, why is that, right? Why can't open a bank at EQ or assess or Stack or Alterna online on my phone? How come I can't do that with my other large bank account? And so the pressure is on the senior executive team of these banks to figure it out, and that's going to trickle down to more partnerships and potentially more acquisitions and investments.
Rob, Corey, any perspective on that?
Yeah, no, just I would agree with exactly what Ranjit said. I mean, we even saw it in the government programs, right? As the government came out with the programs, the CBIN and all that, the ability to automatically put the money into their account and set everything up. The banks were kind of caught off guard on that, right? And so it showed some real breakdown in a lot of their core technology. Dealing with a mortgage deferral became, having to get someone online to have the conversation, right? As opposed to being able to do it digitally through the mobile app or through an online channel. So, I think everyone now is worried about the second wave and the third wave. They're worried about the fall. and they're madly trying to spend their way into, fully digitizing their personas of their different client bases or member bases. And fintechs can plug those holes and plug those gaps to take care of the market. When unfortunately, I think we're seeing in the GTA and in Quebec, Ontario and Quebec, where rolling back and branch hours will be restricted, some will be closed. And so now I think, I agree with Ranjit, now's the time, if fintechs can plug those holes and create value, the execs and the CEOs at the big five or big six are going to move heaven and earth, right? So if there's a time to partner or to get a good evaluation, it's kind of right now, because the corresponding issue they have is the President's Choice Financial that just launched their new offering this week. And, think about that. PCF's back in the game of checking accounts and bill payments. And they now, though, have a 22 million Canadian member loyalty program. I believe it's the single largest loyalty program with the highest level of engagement and satisfaction in the country. If you don't think that awoke the empty towers on Bay Street right now, as they're all in COVID isolation, we'd be kidding ourselves. So now's the time for fintechs to really try and come forward and plug those values.
There's not much I can add to that. I think at the very beginning of the pandemic, there was a little bit of retrenchment because people didn't know what this was going to mean and for how long, and managing their own business. And then very quickly, attention turned to digital transformation. And it isn't just e-commerce that's seen a boom over the last 3 months or 6 months. It's also seen digital banking explode in utilization. For the first time as a Canadian, I think I saw driving down Bathurst Street or Yonge Street or Avenue Road promotions for mobile banking, right? Like, use mobile banking. This is a thing that exists, and you may have known about it because, how might not you have, but now that you're not coming into the branch, this is going to be the primary way you're going to be banking. So let us help serve you better from a distance. And we've certainly seen the interest and pickup for not just how to serve people digitally, but how to replace. I mean, earlier today, I was on a call with the large national financial institution, and they basically said the thing that they're most worried about right now is how to digitize that relationship that you would seek out in branch for financial advice, for help. There are businesses that are suffering through this pandemic that want to speak to somebody, and from the time they opened up their account to now, they've only known Cheryl or Steven or Veronica over at their local branch, and now they don't just have that same access. So how are we going to evolve the relationship aspect of banking in a digital world or in a post-COVID world? That's something that banks are heavily looking at investing in. It's a combination of digitization, personalization, and obviously financial wellness tools.
Perfect. One last question that I'll squeeze in because she asked it 5 minutes ago. So this one's from Anna for you again, Ranjit. Given experience in B2B payments platform through Stack, what types of gaps do you see in credit card space for small and medium-sized businesses that suffer through banking platforms that are way behind the digital?
Yeah, I mean, don't get me started on business banking. I think it's ripe for disruption. There's a few companies doing that. I think, Stack was a small business, and we had a bank account with a large bank, and it was like taking a time warp back to 2002 in terms of the experience and what you can do on their banking portal. So I think, look, there's a massive opportunity for fintechs to enter that space and offer business banking solutions. And the definition of a small business has changed as well, right? It could include sole proprietor gig workers to small startups, medium-sized startups. And so anything from managing cash flow, a big issue is getting, for any business, but especially for small businesses, getting access to cash as quick as possible. So cash flow management, even things like disbursement for payment and salaries, right? So, I think there's definitely, and we've been working in that space in full transparency, looking into that space as well. I think, having a lightweight kind of card product platform like Stack has, and Stack is white labeled, can solve a lot of the problems small business have dealing with traditional kind of banks that are built off like, old core banking platforms that essentially can't scale to real-time payments or real-time disbursements, or being able to on your card just simply is blocking certain merchant payments. So if you have employees on the workforce that need to that are making purchases on your behalf, having a card that doesn't allow alcohol or tobacco purchases, right? Like simply having a flexible platform that you could regulate payments and disbursement and manage that. I think there's a lot of opportunity in that space for sure.
Perfect. Well, on that note, I want to thank the three of you, and Corey, Ranjit. There seems to be a lot of interest to learn more about your company. So I wish we had more time to actually dive into. We had to stick it around the topic of M&As given today's theme, but perhaps in the future we could learn more about both of your companies. And Rob, with your wealth of experience and knowledge, and I see you in the comments generously offering to connect with people. So greatly appreciate the three of you coming on for this Fintech Drinks. And thank you so much for sharing your knowledge with everyone this evening.
See you, Corey.
Thanks so much. Take care, everybody.
I'll just wrap up before we open up the networking. So I'll just go ahead and share my screen one last time. Like to thank again our sponsors, EY and Expertus, for making tonight's event and all the Fintech Drinks possible. Thank you so much for your continued support. We have a poll right over there where you could share your feedback. Please let us know what you thought about this event. You could also email us if you have any suggestions, what you want to see, any topics or speakers you would like to hear from in the future. We always love hearing from you and hearing what you thought. Happy to announce the next Fintech Drinks already coming up in October, on October 21st. And it kind of segues from the conclusion we had during tonight's panel. We're going to be speaking about building the ultimate financial experience. So last month we spoke about digital transformation, so more on the internal side. Now it's from the user experience side, how to craft this new digital banking experience with the panelists composed of Abdullah El-Tarazi, the Chief Business Development Officer at Expertus, Corby Fine, VP Digital at GoEasy, and Mahima Podar, the Senior Vice President of Digital Banking and Strategy at Equitable Bank. So we'll show you an email so you could register. You should get that tomorrow. And now we're on to the networking. So we call it 3-minute networking. It's now open. You can see it on this side of the screen. Essentially, we have 20 minutes left. So you should be able to meet about 6 people. You click to join, and then randomly you're assigned to somebody who you'll meet for the next 3 minutes to be able to learn about what you guys do. Who knows, maybe create some connections or a new drinking buddy at the least. So that's it. Thank you everybody for joining us for yet another edition of Fintech Drinks. My name's Nick. Thank you for being with us, and we'll see you again next week. And maybe I'll see you in the networking. Take care.